Look, I'm not going to sugarcoat this for you. While most people sit down every April shuffling through their W-2s on TurboTax, wondering why their refund is so pathetic, there's a completely different group of people playing an entirely different game. And I'm not talking about illegal tax evasion or hiding money in the Cayman Islands like some drug dealer. I'm talking about understanding the rules of the system, rules that were written in plain language for anyone who bothers to read them, but that most people will never learn because they're too busy complaining about how unfair the system is. Here's the reality nobody wants to tell you. The United States tax code, and really tax codes around the world, weren't designed to collect the maximum amount of money from everyone equally. They were designed as policy tools. The government uses tax incentives to encourage certain behaviors and discourage others. They want you to invest in real estate. They give you depreciation. They want you to take risks and build businesses. They give you capital gains treatment. They want you to hold assets long term instead of trading like a maniac. Different tax rates. This isn't some conspiracy. It's printed right there in the Internal Revenue Code for anyone willing to do the homework. But here's what kills me. The average person, the W-2 employee, wakes up, goes to work, gets a paycheck with taxes already taken out, and thinks that's just how the world works. They never stop to ask why their effective tax rate is 30%, while someone worth 100 times more might be paying 15. And before you start with the pitchforks and the eat the rich nonsense, let me tell you something that might sting a little. It's not because the system is rigged against you. It's because you're playing employee while they're playing owner, and the tax code was literally written to favor owners. And by the end of this, I'm going to show you where the next major distortion in the tax game is happening, something almost nobody is paying attention to because they're too distracted arguing about politics on Twitter. Let's start with the fundamental difference between earned income and capital gains. When you work a job, you trade time for money. The government looks at that transaction and says, we're going to tax that at ordinary income rates, which federally can go up to 37%, and that's before state and local taxes pile on. But when you own an asset, whether it's a business, real estate, stocks, whatever, and that asset appreciates in value, you're not taxed until you sell. And when you do sell, if you've held it longer than a year, you're taxed at capital gains rates, which top out at 20% federally. Already you can see the game. Time for money gets hammered. Money making money gets a discount. Now, why does this exist? It's not because politicians love rich people. Politicians love votes, and most voters are employees, not capital allocators. The reason is economic policy. The government wants investment. They want people taking risks, building businesses, creating jobs, developing real estate, innovating. When you penalize capital formation with the same rates as ordinary income, you get less of it. It's supply and demand applied to economic behavior. You want more of something, make it attractive. You want less of something, tax the hell out of it. This is why cigarettes are taxed heavily and why municipal bonds are tax-free. It's policy, not some shadowy cabal. But here's where it gets interesting and where most people completely miss the boat. The truly wealthy, the people playing the game at the highest level, aren't just benefiting from lower capital gains rates. They're structuring their entire financial lives to minimize taxable events altogether. They borrow against their assets instead of selling them. Think about that for a second. If you own $100 million worth of stock and you need $5 million to buy a house or fund a new venture, you don't sell the stock and trigger a 20% capital gains hit plus net investment income tax. You borrow against it at 3 or 4% interest. The interest might even be deductible depending on what you use it for. You keep the asset, it keeps appreciating, you get your liquidity, and the IRS doesn't see a dime from that transaction. This is what I mean by playing a different game. And real estate, my world, takes this to another level entirely. Depreciation is the most beautiful thing the tax code ever invented for anyone willing to own hard assets. You buy a building for $10 million. The IRS says, Even though this building will probably be worth more in 20 years than it is today, we're going to let you pretend it's wearing out. Take a deduction every year for the next 27 and a half years if it's residential, 39 if it's commercial. So you're generating real cash flow from rent, but on paper you're showing a loss because of depreciation. That loss can offset other income. You're making money and paying little to no tax on it. And when you eventually sell, there's a thing called a 1031 exchange. You roll the proceeds into another property, defer the capital gains indefinitely, rinse and repeat until you die, at which point your heirs get a stepped-up basis and the tax liability evaporates entirely. Let me be clear about something because I know exactly what some of you are thinking. This isn't cheating. This is the government handing you a playbook and most people being too lazy or too ignorant to read it. Every single thing I just described is legal, encouraged, and explicitly written into law. The government wants capital flowing into real estate because it creates construction jobs, property management jobs, maintains housing stock, all of it. They want people taking entrepreneurial risk because that's how you get economic growth. They're not hiding this. You're just not paying attention. Now let's talk about business ownership because this is where the gap becomes a chasm. If you're an employee, you get your paycheck, taxes come out, and you live on what's left. If you own a business, you get to deduct every legitimate expense before you even calculate what you owe in taxes. Your car, if you use it for business, your home office, travel, meals with clients, health insurance, retirement contributions, the list goes on. You're playing with pre-tax dollars while the employee is playing with post-tax dollars. An employee wants to buy a laptop, they pay with money that's already been taxed at 30%. A business owner buys the same laptop, it's a deduction, effectively a 30% discount courtesy of not paying tax on that income. But it gets even better. Let's say you own an operating business that generates $2 million a year in profit. You can pay yourself a reasonable salary, let's say $200,000, pay ordinary income tax on that, and then take the remaining $1.8 million as distributions, which depending on your structure, could be taxed at qualified dividend rates or pass-through rates, both significantly lower than ordinary income. You just saved hundreds of thousands of dollars in taxes compared to if all $2 million came to you as W-2 income. And if you're smart, you're reinvesting a chunk of that back into the business, taking deductions for equipment, expansion, R&D, whatever, further reducing your taxable income while building enterprise value. Here's the thing that really separates the people who get it from the people who don't. Skin in the game and asymmetric risk. When you own assets, you're taking real risk. Real estate can go down. Businesses can fail. Stocks can crater. The tax advantages exist because you're putting capital at risk in productive uses. The employee has a different risk profile. They trade time for guaranteed money. No capital at risk beyond their own labor. The tax code reflects that difference. It's not unfair. It's just different optimization for different choices. And let's address the elephant in the room because I know some of you are sitting there thinking this is some moral failing of society. Why should someone making $50,000 a year as a teacher pay a higher effective rate than someone making $50 million as an investor? Here's the brutal truth. Because the person making $50 million is creating jobs, deploying capital, taking risks that generate tax revenue from dozens or hundreds or thousands of other people. One successful real estate development creates construction jobs, property management jobs, retail jobs if there's commercial space, property tax revenue for the municipality, sales tax from the businesses that operate there. The multiplier effect is enormous. The teacher, as valuable as education is, doesn't generate that same economic multiplication. The tax code is written to encourage the behavior that has the bigger economic impact. You might not like that. You might think it's unfair. But it's rational policy if your goal is economic growth. Now here's where most people make their biggest mistake when they learn about all this. They think the solution is to lobby for higher taxes on the rich or to eliminate these loopholes. That's the poverty mindset talking. The real solution, if you want to build wealth, is to change which game you're playing. Stop trading time for money and start trading capital for returns. Start a business, buy rental property, invest in assets that appreciate. Structure your life so you're playing by the same rules as the people you think have an unfair advantage. Because here's what nobody wants to hear. The barriers to entry for most of this aren't actually that high anymore. You don't need to be born rich to start an LLC and run a side business that generates deductible expenses and potential capital gains on exit. You don't need millions to buy your first rental property with an FHA loan and 3.5% down. You don't need to be an accredited investor to buy index funds and hold them long-term for capital gains treatment. What you need is the willingness to take risks, to educate yourself, and to stop thinking like an employee. The real wealth gap in this country isn't between people who make a lot and people who make a little. It's between people who understand how money works and people who don't. It's between people who own assets and people who don't. It's between people who read the tax code or hire someone who does, and people who just sign whatever TurboTax tells them to sign. And the most frustrating part is that all the information is available. It's not secret. It's not hidden. You just have to care enough to learn it. Let me give you a specific example of how this plays out in real life, because theory is one thing, but application is where it matters. Let's say you're a software engineer making $200,000 a year, great salary, you're in a high tax bracket, probably paying close to $60,000 or $70,000 in federal taxes alone, more with state and local. You're living a nice life, but you're on the hamster wheel. Every year you make your $200,000. Every year you pay your $60,000, $70,000 in taxes. Every year you're left with your after-tax income to spend or save. Now let's say instead you take that same skill set and you start a software consulting business. You form an S-Corp. You pay yourself a reasonable salary of, let's say, $100,000. You pay ordinary income tax on that. But the other $100,000 flows through as business profit. You've now deducted your home office, your computer equipment, your software subscriptions, your continuing education, business travel to conferences, client meals, all of it. Let's say those deductions add up to $30,000. Now you're only paying tax on $70,000 of that second $100,000, and it's at the lower qualified business income deduction rate. You just saved $20,000 or $30,000 in taxes compared to the W-2 scenario, and you haven't changed what you do for a living one bit. You just changed the structure. Take it further. That $30,000 you saved, invested in a rental property. Now you're generating more income, but it's offset by depreciation. The property appreciates over time. In 10 years, you sell it using a 1031 exchange, roll into a bigger property, defer the gains. Meanwhile, you're building a balance sheet of assets that produce cash flow and appreciate. 20 years from now, you could have a portfolio worth millions, generating hundreds of thousands in annual cash flow, paying minimal taxes because of depreciation and leverage, while your former colleague who stayed W-2 has just been climbing the corporate ladder, making more money, but paying more taxes with no asset base to show for it beyond a 401k. This is what I mean by different games. It's not about tax evasion. It's not about being unethical. It's about understanding the rules and structuring your financial life to play the game that has the best odds, and the odds are stacked heavily in favor of ownership over employment. Now let's talk about something most people don't think about: estate taxes and generational wealth. The current estate tax exemption is over $13 million per person, over $26 million for a married couple. That's before you owe a dime of estate tax. But here's the beautiful part. Assets that you've held your entire life that have appreciated enormously, that you've deferred taxes on through 1031 exchanges or just by holding stocks, those assets get a stepped up basis when you die. Your kids inherit them at the current market value, not what you paid for them. All those unrealized capital gains vanished tax-free. You effectively got to build wealth on appreciation that was never taxed at all. Compare that to someone who spent their whole life as a W-2 employee, paid taxes every year, saved what was left, maybe accumulated a few million in retirement accounts. Those retirement accounts, ordinary income tax when the kids withdraw them. No step up, no benefit, just a tax bill. The employee paid taxes their whole life, and their heirs pay taxes on what's left. The owner deferred taxes their whole life, and their heirs start fresh. It's a completely different outcome based purely on understanding the structure of the tax code. And here's where I promised you the distortion that nobody's talking about. Right now, there's enormous political pressure to raise taxes on the wealthy. Wealth taxes, higher capital gains rates, unrealized capital gains taxes, all of it. Most people cheer for this because they think it'll create fairness. But here's what actually happens. The truly sophisticated capital allocators, the people playing at the highest level, they're already moving. They're restructuring into opportunity zones. They're using trusts and family offices in tax-favorable jurisdictions. They're investing in growth assets that don't produce current income. They're doing charitable remainder trusts and donor-advised funds. They're layering complexity that makes their effective rate even lower than it is today. Meanwhile, the upper middle class, the successful professionals who are W-2 employees making $300,000, $400,000, $500,000 a year, they're going to get destroyed. They make too much to avoid higher rates, but not enough to afford the sophisticated planning that the truly wealthy use. They're the ones who will bear the brunt of any tax increases because they're the easiest to collect from, and their income shows up on a W-2. There's nowhere to hide, and they'll keep voting for these policies thinking it's going to hurt people richer than them, not realizing they're the actual target. The distortion I see coming, and this is what you need to pay attention to, is in opportunity zones and qualified small business stock. These are the new 1031 exchanges, the new depreciation shelters. Opportunity zones let you defer capital gains indefinitely if you invest in economically distressed areas. QSBS lets you exclude up to $10 million in gains from the sale of qualified small business stock if you hold it 5 years. These are massive, massive tax benefits that were slipped into the code relatively recently, and most people have no idea they exist. The smart money is already pouring into these structures. In 10 years, you're going to see another wealth explosion from people who understood and used these tools while everyone else was arguing about whether billionaires should exist. Here's my advice, and I know it's not what you want to hear because it requires work and risk and discomfort. Stop complaining about the tax system and start using it. Educate yourself on business structures, on real estate investing, on capital allocation. Hire a good CPA who thinks like an advisor, not just a compliance person. Start building assets instead of just earning income. Change your relationship with risk. Understand that the tax benefits exist because you're taking the risk of ownership. And if you're not willing to take that risk, you don't get the benefits. That's not unfair. That's rational. And look, I get it. Not everyone can or should be an entrepreneur. Not everyone wants to be a landlord. Not everyone has the stomach for investing. But if you're going to choose the employee path, then you need to accept that it comes with a different tax outcome. You're choosing safety and predictability over risk and reward. That's fine. It's a legitimate choice. But don't then complain that people who chose differently get different results. They're playing a different game with different rules and different risks. The bottom line is this. The wealthy aren't playing a different game because they're cheating or because the system is corrupt. They're playing a different game because they learned the rules, they took the risks, and they structured their financial lives accordingly. Every single thing I've talked about today is available to you. You can start an LLC tomorrow. You can buy a rental property next month. You can invest in an opportunity zone fund next quarter. The information is all out there. The rules are published. The question is whether you're willing to do what it takes to play by those rules. The people who build generational wealth understand something fundamental. Income is taxed, wealth is not. Get off the income treadmill and start building a balance sheet of appreciating assets. Use the tax code the way it was designed to be used. Take the risks that the incentives were created to encourage. Stop thinking like an employee and start thinking like an owner. That's the game. That's how it's always been. That's how it's always going to be. If you want to learn how to think like an owner instead of an employee, if you want to understand the fundamentals of wealth building instead of just chasing the latest investment fad, hit that subscribe button and give this video a like. I'm going to keep telling you the truth whether you want to hear it or not, because that's what you need. And if you've got questions about your specific situation, about assets you're looking at, about strategies you're considering, leave them in the comments. I'll do my best to give you straight answers, even if they're not what you want to hear. Because the truth, uncomfortable as it might be, is the only thing that's actually going to help you build wealth in the real world.